Hello and welcome back to the show, everyone. I am Jennifer, and I am so excited to dive into today's topic because, honestly, it drives me absolutely crazy.
And I am Liam. It is great to be here. You're definitely not alone in that feeling, Jennifer. Today, we are tackling one of the biggest mysteries and frustrations in the financial world.
Exactly. So here's the deal, Liam. I just finished filing my taxes, and looking at how much the government took for my paycheck was painful. But then I read headlines saying multi-billionaires paid zero in federal income tax, or a tiny percentage compared to what I pay. How is this even legal? Are they just breaking the law?
It sounds completely unfair, but the short answer is no. They're generally not breaking any laws. In fact, they're following the tax code exactly as it is written. The problem is that the system is designed for two different types of people: people who work for money and people whose money works for them.
Okay, but money is money, right? If I make $100,000 and a billionaire makes $100 million, shouldn't they just pay a higher percentage? Why does it seem like the system is rigged in reverse?
That is the logical way to look at it. But here's the first secret. Billionaires do not make an income like you do. You get a paycheck. That is called W-2 income. The government taxes that immediately. You see it disappear before it even hits your bank account.
Right. It is gone before I can even touch it.
Exactly. But the ultra wealthy usually have a very small salary, sometimes just $1 a year. Their wealth isn't in cash flowing into a bank account. It is locked up in assets, mostly stocks in the companies they own. And here's the golden rule of tax. You are not taxed on things you own, only on things you sell.
Wait, let me wrap my head around this. So, if Jeff Bezos or Elon Musk sees their company stock go up by $10 billion in a year, the IRS doesn't care?
Precisely. That is called an unrealized gain. On paper, they are $10 billion richer. But until they actually sell that stock to get cash, the tax man cannot touch it. It is invisible to the tax system.
But Liam, that doesn't make sense practically. They still live in massive mansions, fly private jets, and buy islands. They need cash to do that. They can't buy a yacht with Amazon stock directly, right? They have to sell the stock eventually to spend it, and then they would get taxed.
That is what you would think. But this is where we get into the most famous strategy of the ultra rich. It is called buy, borrow, die.
Buy, borrow, die? That sounds dark. What does that mean?
It is brilliant and completely legal. Step one is buy. You buy assets or start a company that grows in value. Step two is borrow. This is the magic trick. Instead of selling their stock to get cash for that yacht, they go to a bank and say, hey, I have $1 billion in stock. Lend me $10 million cash and use the stock as collateral.
Okay, so they take a loan, but they still have to pay the loan back, and loans have interest rates. Wouldn't the interest cost them a fortune?
For you and me, maybe. But when you are a billionaire, banks see you as zero risk. They give you incredibly low interest rates. But here's the kicker, Jennifer. Loans are not income. You do not pay tax on borrowed money. So they get 10 million cash to spend, tax-free, and they keep their stock, which keeps growing in value, faster than the interest on the loan.
My jaw is actually on the floor. So they live off credit cards, basically, but on a massive scale, just to avoid paying income tax.
Essentially, yes. They live on debt. And because their assets grow by maybe 8 or 10% a year, and the loan interest is maybe 2 or 3%, they are actually making money by borrowing.
Okay, so that is the buy and the borrow. What about the die part? That sounds morbid.
It is morbid, but financially powerful. If they sell the stock while they are alive, they pay capital gains tax. But if they hold the stock until they die, the tax basis of that stock gets reset. It is called the step up in basis.
Explain that simply, please. I feel like I am getting a headache.
Okay, simple terms. Imagine you bought a stock for $1, and when you die, it is worth $100. If your heir sells it the next day, The government treats it as if they bought it for $100. That $99 of profit, tax-free forever. It vanishes.
That is unbelievable. So the government never gets a cut of that growth?
There isn't a state tax for a very large amount, but with enough lawyers and trust funds, they can minimize that too. But regarding the income tax we all complain about, yes, the growth vanishes.
It feels like the game is totally rigged. But Liam, surely they pay some taxes? What about when they actually do sell something or own property?
They do, and to be fair, in total dollars, they pay a lot. But as a percentage of their true wealth growth, it is tiny. And there is another tool they use called depreciation.
I've heard this word regarding cars losing value. How does it help a billionaire?
So if you buy a rental property or a private jet, the tax code assumes that asset is wearing out over time. It lets you deduct a portion of the cost from your taxes every year as a loss, even if the property is actually going up in value.
Wait, so the building gets more expensive to buy, but on their tax form they tell the government it is losing value?
Bingo. Real estate developers love this. They can make millions in cash flow from rent, but on their tax return, the paper losses from depreciation make it look like they made $0. So they pay zero tax.
It sounds like the tax code is written for business owners and investors, not for employees.
That is the truest thing you have said all day. The government incentivizes business and investment. They want people to build housing, start companies, and create jobs. So they give tax breaks for doing those things. If you are just a W-2 employee, you don't get those incentives. You are the low-hanging fruit for the IRS.
So, is there any hope for the average person? Can I use these strategies? Or do I need a private island first?
You don't need an island, but you do need to shift your mindset. You can use the buy part. Instead of keeping cash, buy assets like index funds or real estate. You can use tax-advantaged accounts like 401ks or IRAs, which shield you from taxes temporarily.
So, the goal is to stop relying purely on salary and start owning things.
Exactly. You want to move from being taxed on income to being taxed on capital gains, which are usually lower rates. Or better yet, own assets that you never have to sell.
It is frustrating, but also kind of empowering to know how the machine works. It is not magic, it's just a rule book I haven't been reading.
It is just a rule book. And once you know the rules, you can stop being mad and start planning your own strategy.
Well, I am definitely going to look at my finances differently now. No more just letting cash sit there.
That is the Spandit.
Thank you so much for breaking this down, Liam. This was eye-opening. And for everyone listening, if you want to understand more about how money actually works, make sure you hit that subscribe button.
We're dropping new episodes every week to help you master your wallet. Don't miss out. See you next time.
Bye, everyone.